In this short video, we look at our recent initiation on Faroe Petroleum and some of the key themes within our note. Based on our analysis and our underlying commodity price assumptions and cost of capital assumptions, we think the market is fully valuing Faroe's production assets, but undervaluing its risk development and prospective resource. Our base case valuation is £1.85 per share, and that's based on a long-term oil price of $70 per barrel, and also a cost of capital of 10%. That would increase to £2.15 if we were to assume a slightly lower cost of capital assumption of 8%. Given historical basin-wide success rates in Norway, Faroe's drill-ready prospects, and also the post-tax cost of drilling in Norway, we feel that the market should at least be placing some value on the company's exploration portfolio. Key sensitivities in our valuation include clearly oil price, discount rates, and also gas prices. Within our note, we also provide alternative valuation ranges based on a number of different approaches. We flex for oil price, we flex for cost of capital, and also have a look at what it would look like using historical Norwegian 2P M&A multiples. We apply a multiple of $11.3 per barrel for 2P reserves that are in production, and also $5.5 per barrel for 2P reserves that are currently under development, and both of those based on historical transaction values on the NCS. Adjusting for financial items, that arrives at a valuation of £1.62 per share. Exploration remains at the heart of Faroe's growth strategy, and almost 75% of 2P reserve growth from 2013 to 2018 was added through the drill bit. Larger discoveries include Maria, Fenja, Oda, Braza Bauga, and also more recently Vogelberg. To achieve a sustainable program of drilling candidates, Faroe participates in licensing rounds. These are in Norway, the UK, and also Ireland. And it's picked up 89 APA license awards since 2008, consistently sitting amongst the top quartile in terms of awards won. Exploration and appraisal projects are centred around three hubs. Those are Ula, Braza, and Njord, and 90% of Faroe's 2P reserves are connected to these hubs. This focus on near-field opportunities allows any discoveries to be monetised relatively quickly and cheaply through subsea tiebacks. And this approach is exemplified in success at Braza, which is Faroe's flagship operated development, in which it has a 50% working interest. It was discovered in 2016, praised in 2017. It's actually one of the largest finds of 16 and 17 on the NCS. Faroe estimate a 2P reserve base net to them of over 30 million barrels, and first oil at Braza is targeted for 2021. Faroe commenced an exploration and appraisal drilling program in late 2017, and to date has had significant successes with the Iris Hades discovery and also the appraisal of nearby Vogelberg. Iris Hades discovered gas condensate across two separate reservoirs, and that's estimated to hold a combined gross 2C resources of 210 million barrels of oil equivalent. Faroe is ramping up its NCS exploration program in the second half of this year and going into 2019 with 6 wells, and this follows one well in the UK called Aga Plantain. Iris Hades is one of the largest discoveries worldwide this year, and if converted to 2P, would be a significant addition to current reserves, which stand at 98 million barrels of oil equivalent. And Faroe's benefited from the exceptional tax terms in Norway, with net historical finding costs averaging just over $1 per barrel of oil equivalent. Based on our forecast of an anticipated expenditure on planned exploration and development projects, we believe that Faroe is fully funded at an oil price down to $40 per barrel, based on our production forecast for development assets. This will take production organically from 12,000 barrels of oil equivalent a day to around 35,000 barrels a day based on our forecast. And that would be substantially higher if we were to include a development for Iris Hades as a standalone development. We currently assume just a subsea tieback. Prudent financial management has been a key part of the Faroe story, and it's been able to position the company to monetize its reserve base without significant dilution. Expensive sources of capital, including farm out or equity, have been minimized. Lastly, we look at M&A activity on the NCS. Faroe's acquisitions of interest in producing assets such as Ula, Tamba, Osvalva and Trim from Dong E&P appear to have been well timed in July 2016. In fact, oil prices have risen around 70% since that transaction was announced, and Faroe's been able to extend the field lives of a number of the fields it's actually acquired. February's 2018 sale of a 17.5% stake in Fenja to Suncor appears to be done at broadly in line with historical development asset transaction values. And that was driven by Faroe's desire to diversify development risk, and management expect a 28% leverage IRR for that particular transaction. Lastly, DNO's April 2018 acquisition of an additional 15.37% stake in Faroe was priced at £1.20 per share, or $5.2 per 2p barrel. And that appears to be around 56% below the mean historical NCS corporate transaction value of around $11.8 per barrel of oil equivalent. It's also 35% below Edison's risked exploration net asset value.